costs. For those who are interested in costs, and these are all in costs. Okay, so what you want to understand is if you're looking at this area, you may talk to some people who would say, well, we have operational costs of X, and other people will say we have operational costs of Y, and then other people will say, well, we have reinsurance costs of X, and other people will have reinsurance costs of Y. I mean, you can't isolate in on any one thing. You have to figure out what your total cost of ownership is going to be in order that you can help your clients make an intelligent decision. And all of these costs are out there. And most captive managers fall within a range of each other that is, I don't want to say it's reasonable because it's not always the case, but I mean, it's a relatively close range. I mean, this market is pretty efficient. Captive managers are competing for business, and to some degree, it's you get what you pay for, in my experience. But make sure you're getting the all-in costs when you're, including if the life insurance is involved, you know, who's getting paid commissions, because that's, you know, if they're saying, well, we'll operate this thing for $5,000 a year, you got to ask yourself, how are they doing that? And the answer is probably that there's insurance commissions involved that are probably pretty substantial. And that's a cost to the client because obviously there's, you know, life insurance costs reduce the efficiency of investing. I'm not saying it's a good or bad thing. I'm just, you know, or whatever. Obviously there's people who think it's a great thing. We use life insurance all the time. But it's a cost in the structure and should be factored into the total cost of ownership. Here's just some ranges, you know, even amongst the captive managers that we use, anywhere on the low end from $80,000 to a high end of $190,000, and then $72,000 to $115,000 for years 2 and beyond. So the first year is always going to be more expensive. Years 2 and beyond are going to be less. What you're seeing here is not just a difference in the cost of managers. What you're seeing here is on the low end, the total cost on an outside the U.S. basis, where the $190,000 would be a U.S.-based captive with higher costs of operation, higher costs of compliance, and so forth. And again, is one of them right or wrong? And the answer is no. I mean, it's going to be whatever the client is driven to do. If they've got reasons why they want to be in the U.S., it's okay with me. It's just going to cost them more, which is okay with me. It just makes the vehicle less efficient. But if it fits their other goals and objectives, then it's perfect. But you can see a pretty wide shift there, and that's, again, really not managers so much as it's driven by jurisdiction.